It's been in the making since the beginning of the year, but I think we can finally say that the price increase in the used car market is over. And many of you are probably delighted to hear that. For almost 2 years we saw used car prices climb up, hereby making it increasingly expensive to buy a car if you had no trade-in. However, during the last 6 months, prices did not increase above the market top that was set at the end of 2021. Even depreciation made a comeback, but what's next? Will prices crash by 30% like some sources claim, continue their upward path, or just meander around current levels? Let's find out. We start with an overview of the used wholesale prices. Over here we have in grey the seasonally adjusted price trend and in blue the non-adjusted version. Normally I only show you the adjusted version that goes back to 1995, but as you will see shortly, there are solid grounds to look at the non-adjusted version now. Let's have a look at the numbers. Due to inflation, used car prices tend to trend up when you take a long-term perspective, but this all changed in the beginning of 2020. Prices dropped as there was a lot of uncertainty following the pandemic, but they quickly recovered and surged to historic heights. Demand increased as people didn't like to use public transport and disposable income rose. At the same time, new supply decreased following poor supply chain management and later the chip shortages. And all of this resulted in a price increase of 47% during 2021. Though, 2022 was off to a different start, a start that might mark the beginning of the end of the upward price trajectory. We can see that prices came down and that the recent price increase did not push values over the 2021 price top. As you can see from the blue line, this does not look like things are crashing. Rather, it looks like the end of the price surge. Also notice the difference between the adjusted and the non-adjusted version. The adjusted version shows a much stronger drop in prices, yet this is just the effect of the adjustment as the spring price increase was lower than usual and also later. And as you can see from the historical development, car prices typically go up during spring. I know that some other channels are using the adjusted version only, but in this case I think it's a little bit misleading. Now one thing to keep in mind is that these are the wholesale prices and not the resale prices that you and I are paying. But no worries, also they are on their way down. Over here we have the weekly wholesale and retail price index for 2021 and 2022. And typically it's so that retail prices follow wholesale prices with a lag of approximately 6 weeks. When wholesale prices increased last year, retail followed. We can see that since the beginning of this year, both retail and wholesale prices are trending down. In fact, the most recent decline is slightly higher than what is typical for this time of the year, while the spring price increase is lower than what's typical. Now based on what we just saw, the price decrease in the wholesale and in the retail prices, I think we can draw a tentative conclusion that this monstrous price increase is over. And as you saw, this also means that depreciation is back, at least for most cars. There were namely significant differences in depreciation patterns between various car types. Over here we have the yearly depreciation trends by vehicle class, and this reveals that mid-size sedans and compact cars did the best. The dark blue line shows the value development per week for 2020, and you can see that these cars benefited a lot from the typical spring bounce. Compact cars had a net loss of 0 and the mid-size sedans lost a few percentage points. But look how different things are in the SUV and pickup categories. The entry and mid-size SUV segments saw a decent spring bounce, but values also fell again in the most recent weeks. Yet, the pickups and full-size SUV segments saw only a minor or no bounce at all. And you don't need to be a rocket scientist to see that things are not looking good in the full-size SUV segment. We can think of a few reasons why this might be the case. These full-size SUVs are, for example, extremely expensive, so it could be so that the price increase in this market was so severe that buyers are now opting out. Alternatively, it could also be a reflection of the increase in petrol prices, but the experts from Cox Automotive, who compiled this data, noted that there is not sufficient evidence yet to link this development to the change in petrol prices. Also, if we look at the depreciation patterns by age group, we can see clear evidence that it's back. We can see that prices came down for all age groups. However, there are big differences in the beginning of the year. You can see that the cars that are 9 to 10 years old held their value well up until week 20. More recently we can see that the patterns are synchronizing and that all cars started to depreciate. So compared to last year, values are down slightly and cars are depreciating again. And this means that demand and supply are approximately in balance. They are on a different level than 2 years ago, hence the high prices, but balanced nevertheless. Let's have a look at the demand and supply. Over here we can see the demand level split by the new and the used cars and by year. relative to 2019. And that's a lot of information, so let's take a moment and break it down. The orange line over here shows the used retail sales relative to 2019. So this means that compared to 2019, sales are down by roughly 20%. The blue line shows the same for the new cars and the dashed line shows it for 2021. Now if we focus on 2022, we can see that sales are below the normal 2019 levels and that it has been consistently below that since the summer of last year. Moreover, during 2022 it has been below 2021. Looking at the trend, there appears to be a recovery, but the momentum is only low. The market is still far away from normal levels. And the same applies to the supply situation. Over here we have the supply development for 2019, 2020, 2021 and 2022. And this reveals that 2022 supply is still far below 2019 levels. However, since Q1 it has been higher than during 2021, so there came a little bit of air into the market and the scarcity levels decreased. We already saw this in the pricing, but we can also see this in the day supply. The day supply shows the average days it takes to sell a car and is therefore a good indicator of the hotness of the market. You can see for example that, compared to 2019, which is the grey line, day supply was extremely low during Q2 of last year. Yet the situation is different now. We can see that the day supply sits around 50 and this means that it's even slightly above 2019 levels. It hereby further reinforces that the used car market is more or less in balance again. Let it be at a much higher price point than 2 years ago. The same thing does not apply to the market for new cars. Supply over there is still extremely tight and the average transaction price is still 2% above MSRP. 2 weeks ago I made a full video on the ins and outs of the new vehicle market, so if you're interested in new vehicles, then I recommend that you click over here. But now then, what does the current situation mean for the rest of the year? There's no shortage of YouTube videos predicting the next big crash, and I always get a bit cautious when people talk about crashes as if they are unavoidable. Looking at the price history, I think it's much more likely that there won't be a crash. When it comes to future prices, I like to think of it in terms of scenarios with probabilities attached to those scenarios. And if you are a subscriber to the channel, you know that I usually follow this approach. Now when it comes to car prices, I have presented the following two price forecasts to you. The first one is the prediction from KPMG. They expect prices to come down between 20 and 30%. Or in other words, one could say that they are expecting a serious correction. However, as I also shared with you during the Q1 market update, this seems like a very unlikely scenario given the way things are developing. We are only seeing small price dips and are already halfway 2022. The second price forecast, the one from Cox Automotive, seems a lot more likely. At the beginning of the year they predicted a price drop of 3%, and in this original prediction the expectancy was that prices would increase during spring following tax refunds. This increases income and hereby demand. Yet, during the summer they expected prices to stabilize, and during the second half of the year they expected prices to come down, resulting from new supply increases. But now that prices are down by a few percentage points, they updated their year-end forecast to -6%. The expected price bounce in the spring was slightly lower than usual, and this new number reflects this. Obviously, this is a much smaller price decrease than forecasted by KPMG. If you want to know why these forecasts are so different, or in other words, what the differences are in the underlying assumptions, then I recommend that you click over here. I namely devoted a full video to it. Nevertheless, to see a big correction in prices, we either need a significant drop in demand or a large push in supply. And currently, it does not look like either of those things is happening. Demand has been increasing slowly, and so far the credit availability hasn't deteriorated drastically. Supply in the new market is also still extremely low following all the production issues. Naturally, also commercial supply is still very low. Off-lease levels are at 16% of 2019 levels, but also repossessions and rental check-ins are well below their normal levels. Now there are some spooky headlines stating that the repossessions will skyrocket, especially in the subprime category. However, as of now, I find the evidence less than convincing regarding a near-term crisis. The devil is in the details when you look at that kind of data. Moreover, delinquencies for all credit quality levels were coming from all-time lows, so it is no surprise that they are normalizing now. But that's perhaps a topic for a different video. We will now wrap up and conclude. We saw that used car prices are down by a few percentage points and that they did not exceed last year's market top. Hence, I think it's fair to conclude that we are experiencing the end of the upward price trend. Moreover, depreciation returned. We saw that cars from all ages are now coming down in value, but that especially the full-size SUV segment is taking a hit. So the used car market is in a more stable shape compared to last year, but this is not only reflected in the prices, it's also reflected in demand and supply. We looked at each one of these individually and also at the day's supply, and this revealed that the days it takes to sell a car is in line with 2019. Looking ahead, we discussed two different price forecasts, and I shared with you that in my opinion, the 6% drop as predicted by Cox Automotive is the more likely one. To me it seems very unlikely that there will be a big crash this year. Now before we end the video, I need to mention that this video covers the car prices for your everyday cars, so not the exotic ones that I usually cover on the channel. But stay tuned, because there will be a separate video on the exotic car market. And with that we arrived at the end of this video. As always, thank you for watching, and if you enjoyed this video, please support the channel by clicking on the like button down below. Thank you.